Deciding on the tax structure of your company is a very important decision. Many people believe that the entity type they select at the state level will automatically determine the tax structure of the company at the federal level, but this is actually not the case. What I'm going to talk about today is forming your company at the state level and then making potentially a different designation for taxes at the federal level. And then I will talk about the different designations you can elect at the federal level. So when you form your company, the two broadest types of company and most common types of companies that people will form at the state level are LLCs and corporations. LLCs and corporations are creatures of state law. They are decided by the states as to what types of entities will be permitted in a particular state. If you were to go and then file for an EIN number for your company, either an LLC or a corporation, and file with the IRS will award you a default tax status based on the type of company you form. But you do not need to select the default status. You can actually mix and match your entity type at the state level with the tax status at the federal level. The two default tax designations for an LLC are going to be either, if it's a single member LLC, the default tax designation would be a disregarded entity. If it's a multiple member LLC, the default designation would be a partnership. Both disregarded entities and partnerships are pass-through taxation types, meaning that the entity itself does not pay any tax. 100% of the profits from the business activities of a disregarded entity or partnership pass through to the owners. With a disregarded entity, there's no filing that even needs to be done at the entity level. It's as if it doesn't exist for tax purposes. All of the income of the disregarded entity, LLC, would show up onto the personal tax return of the individual single owner. When it comes to a partnership LLC, that's a default tax status for a multi-member LLC, the entity itself would file a Form 1065 annually, and that Form 1065 would result in the issuance of K-1s, more than one, because it is a multi-member LLC with partnership tax status, to the individual owners. And those K-1s would then be reported on the tax return of the individual owners. But there is no tax due at the entity level. If you formed a corporation and applied for an EIN number with the IRS, the default tax designation for that corporation would be a C Corp. A C Corp is a standalone taxable entity. It is not a pass-through entity. It must file a Form 1120 annually, and it will owe taxes at the federal rate as well as potentially at a state rate for all the income of the corporation. Federal tax rates have varied from time to time. Currently, they are 21%, and they may vary based on the state in which the corporation was formed, also depending on the source of the income that the corporation receives. So corporation tax filing, the default tax status would be a C Corp. Now, all of these entity types, LLCs and corporations, do not need to stick with the default designation. It's possible for a limited liability company, that's a single member limited liability company, to apply for C Corp taxation. It's also possible for a C Corp to apply for disregarded entity status if it had only one member, or perhaps a partnership if it had more than one member. When it comes to both of these entity types, there's an interesting hybrid structure called the S Corp. An S Corp is not an entity type. You cannot form an S Corp in any state. What you can do is make an S Corp election for your LLC or your corporation. An S Corp would file a Form 1120-S annually, and that Form 1120-S would bifurcate or split the income of the entity into two parts. One would be a reasonable salary, which would be subject to all self-employment or withholding taxes, and the other part would be a distribution, which was not subject to those FICA or withholding or employment taxes. In this way, it's potentially possible to reduce your overall tax burden with an S Corp. But there are some caveats. There are also some caveats to who must file what. The advice I'm giving here is based on a U.S. individual. A U.S. individual has different requirements than a non-U.S. individual. There are also some restrictions on the ownership of S-corps. Typically, an S-corp can only be owned by what I like to call a living, breathing human. There are some exceptions to this rule, but they are very narrow. If you have any questions about tax status, you should obviously speak with your tax preparer or tax advisor, or you can schedule a call with one of our attorneys to speak about your particular situation in more detail.